I'm all right. I'm all right. Let's get started. Hopefully, those who haven't joined, they've seen my message that we start a bit early. Okay, let's get started. So our focus for today's session, there is an assignment that I said you should do over the week. So that's what we want to discuss in today's session. So what is more important is not the answer, but what is more important is making sure we grasp the concept behind answering the questions. So we have done the first part, and we are done with the first part of feeding in the knowledge. What you are supposed to just master now in the remaining period or in the remaining days, it's how you apply that knowledge. So there is gathering the knowledge, then application of that knowledge. So the areas which we said are crucial, like audit risk and auditor's response, you get them in almost every question paper. We are going to have test of controls. You get them in every paper. You also are going to get substantive tests. So those are areas where you should master the technique because it's an area that you know is going to be there. It's an area that you are guaranteed it will be there. So the questions are grouped into two. They are knowledge questions, which don't need you to apply the case, like the one we are looking at on the screen. By the way, this is March, June 2025. Hopefully you all attempted. So it's fine. It's fine. Don't more. Okay, sorry about that. Let's proceed. So I was saying there are knowledge questions. For knowledge questions, these do not require, if it's a knowledge question, you don't need to apply the case. If you read the first question, it's saying, explain the responsibility of Coronado and company under IS 240, the auditor's responsibilities relating to fraud and audit of financial statements. So the note below is saying that you do not need to refer to this scenario. So this one is just a knowledge question. It's not a case-specific question. So it doesn't require you to first of all go through the case. So we can actually start answering this one because it doesn't need you to go through the case first. Okay, so what is the question about? The question is saying the responsibilities. So the question wants us to figure out the responsibilities of auditors in relation to fraud and error. Remember, it's not the responsibility of the auditor to ensure that the financial statements are free from errors. It's not the auditor that should give that assurance that indeed the accounts are free from error. We've verified everything. No, it's not the auditor's responsibility. The responsibility to make sure the accounts are free from error is the management's responsibility. What then is the responsibility of the auditor? So the auditor has the responsibility of, number one, the auditor has the responsibility of, and start with the auditor has the responsibility. The auditor has the responsibility of making sure they have gathered enough evidence. So we can say they are supposed to identify the first requirement. So requirement number one, or the first responsibility, that's to identify and assess the risk of material misstatement. To identify and assess the risk of material misstatement in the financial statements. Which may have been caused by error or fraud. So the auditor is supposed to identify the risk. Remember, that's what we're going to do, identifying audit risk. So it's the responsibility of the auditor to identify risk arising as a result of error or as a result of fraud. So they identify the areas where there is risk. And also another responsibility, because the auditor is supposed to give us an opinion in the end, but the opinion must be supported with the evidence that they have gathered. So the auditor needs to obtain sufficient and appropriate evidence. That's another responsibility that they are required to agree to comply to. They're supposed to obtain sufficient and appropriate evidence. Obtain sufficient and appropriate evidence. So the auditor is supposed to obtain sufficient and appropriate evidence in order, so we can say they're supposed to get sufficient and appropriate evidence regarding the assessed misstatements. Assess the risk of misstatement. So they need to gather more evidence. They've assessed the risk of material misstatement. They need to gather more evidence. They need to gather more evidence. So they need to gather sufficient and appropriate evidence regarding the assessed risk of material misstatements and design appropriate safeguards. So they are required to, so the first thing, you identify where there may be errors, where there may be misstatements. So you identify the risk as an auditor. Then after you've identified the risk, your other responsibility is then to come up with evidence. You find or you gather evidence and design appropriate, not safeguards, but let's use the term responses. So you design appropriate responses. So for every audit risk, you need to design appropriate response. So what is the other responsibility of an auditor? Another responsibility of an auditor we can talk about is the auditor must maintain, auditors must maintain professional skepticism. The auditors must maintain professional skepticism throughout the audit. The auditors must maintain professional skepticism throughout the audit, which will enable them which will enable them to identify potential errors and misstatements. So the key point here is they need to maintain professional skepticism. Having professional skepticism is having a doubting mind, not believing everything from the first value. So if you're an auditor, you should have professional skepticism. It's your responsibility. Don't believe everything from the face value. You audit with professional skepticism. Then we can also talk about how many were required. 1, 2, 3. Now we need one more. So the last responsibility, we can talk about the team. The audit team is a responsibility of the auditor to ensure that the team that they are coming with are made aware of the risk, because we communicate the risks that we have identified, so that at least the team, when you are auditing with the team members, they need to know of the risks identified, even if they were not there on the risk, or they're not there maybe on the meetings that you had with the client. So the audit team, they must be made aware. So we can say the auditors So it's a responsibility to ensure that the audit team is made aware of the risks, and can say the risks, fraud, and potential errors. Risk, fraud, potential errors, which have been identified. Before the commencement of the audit. So the audit team members, they need to know, okay, how is the company that we are going to audit? What are the potential risks that we are likely to find? So if there are any risks that have been identified, it's the duty or is the responsibility of the auditor to make sure, especially the audit partner, the senior partner, they need to make sure the juniors that they are going with, they have been made aware of the risks that they are likely to face. So these are some of the responsibilities that the auditors must have. So they have a responsibility to assess the risk of material misstatement. They have the responsibility to then gather sufficient and appropriate evidence. They also have the responsibility to maintain professional skepticism, so that if there is any potential fraud and potential error, they can quickly pick it out. So they have that responsibility as well. Then they have the responsibility to ensure that the audit team is made aware of the risks. The team needs to know about the risks that they are likely to find. So now let's move on. So you may express it in different ways, but the answers that I thought of are these ones, but you can maybe rephrase it and put it in different ways. So it's not exactly that you have to put it in the same wording, but it must give the same explanation. Now let's move on. So these are knowledge questions. Knowledge questions are based on your reading the notes, on your understanding the topic. But now let's move to the application side, which is based on the case. So the questions on which require application, these ones are based on the case. So it is 1 July 20X5. You're an audit supervisor at Coronado and Company. It is 1 July 20X5. You're an audit supervisor at Coronado and Company, planning the audit of P Company for the year ending 31 August. The company is a retail of food and household items with a large network of stores across the country. Forecasted profit before tax is that the audit manager held a planning meeting with the finance director and has provided you with the following notes. So I think the first thing here should be, let's go to the question and know what was the requirement. Then we can get to read the case. So describe 8 audit risks and explain the auditor's responses. So audit risk and the auditor's responses. From the responses that I marked from the assignment, there are still loopholes, quite a number of loopholes on the audit risk identification there. So please pay attention. We are no longer focusing on the content you now have. Now we want to deal with the application side. So we did mention when we did audit risk and auditor's responses that for a response, audit risk, I want to see 3 things. If you are giving an auditor's response, number 1, you start with what you call an indicator, a risk indicator. I need to see the risk indicator because the risk indicator is part of application. The moment you don't put a risk indicator, you are not going to get your full mark. In some cases, you might not get a mark at all because you have failed to apply the case. The risk indicator is very important in every point. This one, it applies to all the points. Every point should start with our risk indicator. What is the risk indicator? It's a situation given in the case that is showing that a risk might be taking place. So the risk indicator is the situation in the case. In the case, showing that a risk showing that, let's remove a risk. Let's say showing that errors of fraud might have taken place. Errors of fraud might have taken place. So a risk indicator is just a situation that you're saying this situation is giving us a hint that if we are not careful, then errors could have taken place. That's the risk indicator. So the risk indicator is then followed by what? After the risk indicator, we need to hear the accounting treatment. The second part applies in some questions, in some it doesn't. So the accounting treatment, this is where you tell us how the standard wants you to record. We are saying this situation is showing us that there is a possible error. The accounting treatment is telling us that if there was no error, how should it have been recorded? The accounting treatment, that's step 2. Tell us the accounting treatment. This looks at how should this be recorded if there is no error. If there wasn't any error which was made, how should it be recorded? We are saying there's a potential that this could have been, might have been misstated. But if there are no errors, how should it have been recorded? That is the accounting treatment. It's telling us how it should have been recorded if there are no errors. Then besides the accounting treatment, we then move to the last stage. The last stage, so the accounting treatment is applied provided that it's a risk that involves standards in most cases. If it's a risk that is involving the standards, you tell us what does the standard say we should do? What does the standard say we should do? Then we move on to the last stage, which is the risk now. If you are on stage number 3, you are now telling us the risk. The risk is what? You are now telling us what could be understated, what could be overstated. So this tells us what could go wrong if the accounting treatment has not been properly accounted. Was not properly applied. So it must specify. So this one must move on to tell us whether it's understated, what could be understated, what could be overstated, what could be misstated. So we need to know what could be understated, what could be overstated, what could be misstated. Then you get your full mark. So most of the answers were vague. They did not contain all the requirements. If you're answering, you don't write risk indicator, accounting treatment, risk. It's in your mind. You should know this is a risk indicator. This is now an accounting treatment. And this is now the risk. So failing to follow this format may result in unnecessary losing of marks. So please bear that in mind. Then on the response. So on the response, we are talking about, what should the auditor do? And please take note, this is an external audit. This is an external audit. When you're talking about the audit response and the auditors, audit risk and auditors response, it's in the context of external auditors, the firm that is being hired. So what should they do? So an auditor responds with the audit procedures. So think of the audit procedures. So the response should be a procedure. Which procedures? It could be analytical procedures. Analytical procedures involves comparison. The response could involve comparing. That's analytical procedures. It can involve comparison. The response could involve discussion. So a lot of people, they prefer to go for the discussion. It's a good one, but I don't advise to stick to that one. You can use it once. Don't use it more than once. Discussion with the management. Of course, you discuss with the management. It gives you the evidence, but it's not reliable. The managers are the same people who are capable of lying to us. They are the same people that have prepared the financial statements. So we can't then go to the same person. You are suspecting that I'm a thief. You can't come to me and ask me, are you a thief? And you expect me to say, yes, I am a thief. So don't rely on discussion with the manager. However, in some cases, like I mentioned, where there are judgmental areas where there is need for management assumption, we need to hear from them the basis for their assumption. So if it's an area like where there is a provision, where they estimated a provision, maybe it's a provision for redundancy cost. In that case, we need to hear from them the basis for their provision. So that is the other procedure, inquiry. So if you have given the response, you don't say inquiry, but you know in your mind, okay, I'm talking about inquiry here. It could be discussed with the management. That's part of the inquiry. Or you can obtain the bank confirmation. You want to inquire from the bank. You want to inquire from the suppliers. So inquiry, it can involve discussion with the management or inquiry from third parties. So that's inquiry. It can be inquiry from within. Can ask even the employees. You're not only restricted to ask the management. You are a detective. So a detective can ask anyone that they think can lead them to the evidence that they want. As long as we think this person is ideal to give us the information we want, we are allowed to inquire from them. So it's not just a restriction where we need to inquire from the management. Of course, it's the commonly used procedure, but it's not restricted to that. There aren't restrictions to inquiry. So you consider the type of information we want. If the information is involving us doubting the amount for suppliers, we can inquire with the suppliers. Then besides the inquiry, we have this one, which is the commonly used one, inspection. And this one is the best one for an auditor. Inspection is when you're checking for your own, you are reviewing on your own. You are checking WEGA so that you can get the assurance that the information indeed has been recorded according to how you wanted it to be recorded. Because relying on someone else, they may not give us the information we want. They may not go through the same procedures that we want. But if you can inspect for yourself, you can get the information, the exact information that you want. Please, under inspection, we can use the terms such as review. We can use the term review. It's tempting, I know, to use the word check. It's tempting to use the word check, but check is not allowed. It is not audit language. Desist from using the word check. From now onwards, never use it in fact. Check the records. No. Check the documentation. What is checking? They say check is too vague. It doesn't tell us exactly what are you saying. If you are checking, what are you doing? So avoid at all costs the word check. I noticed in one of the assignments, it was used oftenly. That's why I'm highlighting that one. Please, from now on, desist from the word check. Of course, in general terms, you can say, I'm checking the books, But for audit purposes, they say check is not audit language. So desist from, you can replace check with review. You can replace that with inspect the records, inspect, and also don't just use the records. We don't have a record called the records. You must specify. If you are using the inspection procedure, let it direct what exactly are we inspecting. Is it the asset register? Is it the list of creditors? Is it, what is it that we are inspecting? You don't just say inspect the records. We don't have a document called the records. Of course, it might be correct that the asset register is a record, but what are they testing you for audit and assurance? They are testing you as well that, do you know the records? Do you know where assets are recorded? Do you know where expenses are recorded? You don't just say check you don't just say the financial statements or the balance sheet may be misstated. We need to know where exactly is it. You don't just say the asset, which asset. Let it be specific. We don't want generalized answers. Let your answer specifically address the problem. We don't want one size fits all to just say, okay, they are all records. No, let it be specific. Also, on that point of being specific, let's come back to the risk. Let's come back to the point, the last point here is. Another task that I want you to do is download the examiner's report, the last examiner's report, at least 2 of them. I want you to go through them, especially the areas where, so under audit risk and auditor's responses, you can go through the areas where they will say the common mistakes, where they will be highlighting the common errors which students make. By the way, if you were not aware, but I'm sure you should know, audit and assurance is one of the subjects with a very low pass rate, very low pass rate. Is it because the subject is difficult? No. If you have done F5, if you have done other subjects, you might actually find, no, that they aren't even difficult terms that you maybe fail to understand with what is the meaning of this term. So what then makes people fail? For this subject, people fail because of failing to apply the case. People fail because they want to apply the notes. We don't work with the notebook in the answers. We work with the case that we have been given. So we don't need general answers. We need answers that are specific to the case. We also don't need blanket answers like misstated. Misstated should only be used when when the question is not clear whether it's under or overstated. If the question is clear that the assets may be misstated, they will tell you that the asset has been disposed. Then you say there is a risk that the asset was not removed from the asset register, resulting in the asset figure being misstated. Then everything you have said is wrong. Why? Because you have said resulting in the asset figure being misstated. If you are assuming that they might not have removed the asset which has been disposed, then it's a clear indicator that if we have not removed the assets are overstated. So we don't want you to hang in between the line to say misstated works for both. No, let's be specific which side we are on. But in some questions, it might not be clear, or it can be both. It can be under or overstated. In that case, you can use misstated. And also, please make sure in your risk, if you can, let us know the effect in the financial statements. What will be understated? What will be overstated? What will be misstated? Now, let's move on. So inspection, the key point is let it be specific. What are you inspecting? Let it be specific. Which procedure you're using. So if you're reviewing, let it be review which book. Let us know the book. Of course, in this, if it's a response, we don't need to know the assertion. If you can, in some cases, if you can bring it, but it's not at a tested assertion level. So a response and a substantive test is almost the same thing, only that a substantive test is now confirming a balance. It's done at assertion level. But the way you do a substantive test, the way you come up with the auditor's response, they're in the same bracket. They all use the auditor's procedures. Okay, so besides inspection, we have observation, which is less used in observation is mainly for controls. Because audit risk, it doesn't look at amounts only. It can look at the risk of audit risk encompasses the risk associated with the controls and the risk associated with the amount. So we can observe. If we think that the system is not working well, you can observe. So that's all, but use it if you know you can explain it well. Then the last one is reperformance or recalculation. So it's a procedure for the auditor, especially if there are amounts that the auditor is doubting that they have not been dealt with properly. They can reperform or they can recalculate these amounts so that they can do justice to these amounts. Okay. So we have the audit risk and the auditor's responses. We have the audit risk and the auditor's responses. Now, let's go to the case. So what I was doing is very important, more than just going to the answers, because you need to know now when you're drafting the answers, what steps are we supposed to follow? Okay, so I'll read the introduction again. It is 1 July 20X5. You are an audit supervisor at C company and planning the audit of P company. You are a supervisor, and the audit is for the year ending 31 August 20X5. So looking at this, it is 1 July 20X5, and the year is ending 31 August. So it's before the year end. You are planning, it's now a month or it's 2 months before the year end. The company is a retailer of food and household items with a large network of stores across the country. Forecasted profit before tax is 18.8 million. Why do they give you this amount? It's normally a materiality amount. So they sell the profit, the revenue, their materiality amounts. So if you are given, they are not really indicating a risk, but if they tell you about an amount, your income statement, maybe they will say that expenses of 5 million were misstated. You can then go back to the benchmark and say 5 over 18.8 times 100. If it's about the 10% of profit, if that amount is 10% of profit, it's a material amount. But if it is 1% of profit, it's an immaterial amount. You can ignore it. It doesn't pose an audit risk. Because audit risk, we are looking for material amounts. We don't check everything. We don't test every item. We deal with material amounts. So if they give you an item of the profit and loss, you can benchmark it against the forecasted profit. You express it as a percentage of the forecasted profit to determine whether it's material or not. Now, let's move. The audit manager held a planning meeting with the finance director and has provided you with the following notes. So this one has not indicated whether it's a new client or is an existing client. So in some cases, watch out for the point that it's for the audit for the first time. If it's a new client, then there is detection risk. You're not familiar with the transactions of the client. But if it's an existing client, then there is no detection risk. We are used to the business. Now, let's move to the planning minutes. So far, I haven't picked any risk. Now, let's get to the second paragraph. PE company's internal audit department conducts an extensive program of control testing across the network of stores. Internal audit aims to visit every store over a 24-month period. The audit manager has obtained permission. Is the audit manager getting permission from the finance director? So the audit manager has obtained permission from the finance director for the external audit team to rely on the controls testing undertaken by internal audit. Is there a risk there? What do you think? Let's talk. Sanse Sarandeka. Timbonzwa muri kufungeya.
Hello. Hello.
Yes, you can speak up a bit. I don't know if it's my sound, but I can hear you, but it's a bit low.
Okay. In this case, I think there's a risk. The internal audit department only visits the stores after a 24-month period, which is a longer period. It's almost 2 years. So the stores should be visited regularly, especially once a year. Therefore, there's a risk that some errors or fraud may not be detected early.
Okay. Wilma, what do you think?
I also agree with Barbara. In the case that there is, if checks are not done regularly, there is a risk that it omit some of the potential or not take them. Yes.
Okay. The answer that you gave me is the reason why a lot of people are getting 49 interviews. You wonder why, but what is that? Yes, the answer sounds correct, but no, it's not. For this question, it's not. Why? Your focus has been on the length of the period the internal audit is taking and the response of the internal audit. The question is asking about the risk and the response of who? Is the risk and response of the external auditor. So the way you've pitched the answers, of course, there's a risk there, but your focus wasn't supposed to be on the internal audit. The moment you say the audit must be done regularly, that's the response for an internal auditor, not for the external auditor. The question is on external auditors' risks and responses. So we can say that P company, which is the firm we are auditing, P, I won't write in full, let me just say P company has an internal audit. P company has an internal audit department that conducts tests. They said, over a 24-month period. Or that conduct tests. Then we can be told that C company wants to place reliance on the internal controls, or can say on the work of the internal audit department. So far, have I answered the question? No. But am I going in the right direction? Yes, that's a risk indicator. It's a situation given in the case. I have not added anything yet, but I'm saying this is where my risk is going to come from. Then I move. So I've given the risk indicator. Now, what is the accounting treatment, or what is the proper thing to do? We can then say, in order to place reliance, on the work of internal auditors, you first of all need to indicate maybe here, when you initially used internal audit, when you wrote in full internal auditors, got IA. Why? So that later on, particularly IA, the marker knows what you're talking about. So in order to place reliance on the work of the IA, there is need to ensure that they followed. There is need to ensure that they have followed. There is need to ensure that they have followed acceptable standards in their audit. And maintained independence. So there is need to ensure that they followed acceptable standards and maintained independence. Or there is need to ensure the effectiveness of the audit. We need to ensure that the audit was being done effectively. Now you're going to the risk now. If the risk Yangaraba is that if the reliance is placed on the work of the internal auditors, which has not been effectively carried out. There is a risk that the external auditors will, there is a risk that the external auditors will, there is a risk that the external auditors will give wrong conclusions. So they, from my opinion, they deliberately put that point of 24 months, knowing that a lot of people would go for that. But the point is the risk to the external auditors. So the risk is that they place reliance on the work of auditors, which has not been effective. Whenever we are using the work of auditors, there is that risk of relying on the work of the auditors that when the auditors did not do a thorough job, the internal auditors. Remember, the internal auditors are not specialists. These are just employees of the organization who are normally assigned on not even a regular basis, who are assigned to be verifying the controls and to be verifying the system. So placing reliance on their work can put us in danger of giving wrong conclusions. What then should we do? So in this case, before the work, before putting reliance on the work of the internal auditor. So you're asking yourself, should I compare? Is there anything that I should compare? Is there anything that I should inquire? So you're asking yourself, should I inspect? So I'm thinking, before we put reliance on the work of the internal auditors, we can discuss, can meet with the internal audit team or the head of the internal audit team, or we can go to their department and read their reports and go through their instructions of how they conducted the audit and verify if they are in line with the requirements of ESAs. So before you put reliance on the work of the internal auditors, the audit team should review the audit instructions used, the independence, and the audit procedures to confirm if they are in line with the requirements of the ESAs, International Standards on Auditing. We need to confirm that. Did they conduct their audit with independence? Did they use the right procedures? Were they instructed to audit all the areas, or they were just instructed to audit? Were they instructed to carry out a detailed review, or it was not a detailed review? That's the first one. Let's move on to the second paragraph. In May 20X5, a fraud was discovered in the finance department following an investigation. So a fraud was discovered. They will, in most cases, they will give you this, where a fraud has been discovered. So before we go further, if a fraud is discovered, there is already a risk that Isusu might have discovered fraud in one area, but there is a possibility kuti kana patomborine potential yekuti fraud inoitika, vamwe vanogona vakatoitawo in other areas zvikasabatika. So in this case, what are they saying? Fraud was discovered in the finance department following an investigation. The finance clerk at P company was found to be responsible and was dismissed. As a result, the remaining members of the finance department have been allocated additional tasks until a replacement finance clerk can be appointed. This has led to a backlog in the processing of some of the accounting records. So to the auditors, what are the risks? So the risks that we can talk about in this case, the risk is that number one, if an error has been detected, we might believe other areas kutori often errors. Kana vakatombaona an error in one area, it means now the procedure there is to actually increase our professional skepticism, because once the risk has been detected, it means there's a potential for more. So once a risk has been detected, there is room for more. There is room for more. So, but let's start with the audit risk before we get to the response. We can say, always remember, we start with the indicator. We start with the indicator. P companies, this is part of the application. The indicator helps you to apply the case. P companies finance clerk. P companies finance clerk was found to be responsible for the fraud which took place and was dismissed. And was dismissed. So that's indicator. That's an indicator. For this one, there is no accounting treatment. We can just then go straight to the risk. So we can then say there is a risk that more errors and fraud may have taken place. May have taken place, which and have not been detected. more fraud and errors may have taken place and have not been detected. Okay, so anything that we can say there, so more, we can have fraud that has taken place and has not been detected. So you can say resulting in a couple of misstatements or in multiple misstatements. Then what should be the response? The response, in this case, we don't know where else fraud could have taken place. So we can't pinpoint to say, let's inspect this particular record because fraud has taken place and it might have occurred in a number of areas that we have not been. So we can say in the event that you don't know where exactly to check, we talk about increasing professional skepticism. We increase professional skepticism. We can say more detailed testing or perform more substantive tests. In the transactions carried out by the clerk or transactions recorded by the clerk. And increase the general level of professional skepticism. Professional skepticism. Throughout the audit. So we just be alert because so just increase. Fraud can take place in this company. So we increase our general level of alertness. Let's move to the third. So I'll look at the third, then move to the next question so that we can cover other things. During the meeting, so hopefully after this one, you're now picking the procedure. You are now picking the way that you can address the risk and the responses in a way that will guarantee you a mark. So during the meeting, the finance director provided some forecast financial information, which indicates that operating profit margin is predicted to increase from 12% to 17% for the year ending 31 August 2025. The audit file for previous year audit includes details of an adjustment which was required of opening expenses resulting from incorrect cut-off of selling costs. So it's showing that last year there were cut-off issues. Cut-off issues. where the selling costs were not recorded, because if it's cut off, they were not recorded in their rightful period. So let me read that part again. The audit file for the previous year audit includes details of an adjustment which was required to operating expenses resulting from incorrect cut-off . So it means the prior year auditors, they requested that we should make an adjustment. The company should make an adjustment for cutoff. The company should make an adjustment for cutoff because they had recorded selling expenses in the wrong period. So with that in mind, what risk am I thinking of here? The risk is that they have said the profit is from 12 to 17%. They are predicting an increase in profit, which I would like to think this could be a misstatement, a deliberate misstatement. They can overstate the profit. Why do I think like that? Why am I thinking so? It's because last year they played around the selling costs. They might have also done the same this year. There might be cut-off issues as well this year. So if last year there were cut-off issues, what could prevent the same from taking place this year? So as an auditor, it's something that should click in your mind. If they are saying this year we are predicting that the profit is going to be up from 12% to 17%, there is a risk there. You need to take your time, analyze that in more detail. Why are they saying the profit is going to rise from 12 to 17%? It could be they are trying to manipulate the profit. So how then can we put that up? We can say, let's now go and put that one down. So always remember, we start with the indicator. Let's start with the indicator. So the indicator, we can say that the profit is expected. The profit is expected to increase. Profit is expected to increase from 12% to 17%. The profit is expected to increase from 12% to 17%. From 12% to 17%. And another supporting evidence that we want is that in the prior year, the prior audit indicated that, or we can just, that one we can put it on the supports below. So that's the indicator. We can just put that one. The profit is expected to increase from 12 to 17%, or you can highlight the period. Then, again, this one, there is no profit. There is no accounting treatment, but maybe we can just talk about the prudence concept. So, the prudence concept. The prudence concept requires the entity not to overstate profit. not to overstate profit under conditions of uncertainty. Not to overstate profit under conditions of uncertainty. Okay, there is a risk. There is a risk that the profit is, there's a risk that the profit is overstated. And the expenses understated. And the expenses understated. If the previous cutoff issues have not been resolved. If the previous cutoff issues have not been resolved. So what should then be the response? The response is, how then should we verify? How then should we respond as auditors? So we can review the prior reports to see whether this issue was resolved. So remember, the management can decide, they can refuse to make the adjustment. So we need to verify that. So you can say, review the prior year audit file. You can review the prior year audit file in order to gain more insight about the cut-off issue and if it was resolved. And if it was resolved. And increase, can say, and increase substantive tests on the current year expenses. Because last year there were cut-off issues on the expenses tab. So we can also increase my substantive tests, especially to do with cut-off on the current year expenses, to ensure that they have not understated the expenses. They have included, because since they are expecting a high profit, the high chances are, like in this case, you can't say the expenses, there's a risk that expenses are misstated. The question is showing you that profit is increasing. So for profit to be increasing, it means the expenses must be low, they should be understated. They can't be overstated in this case. So there's a risk that profit is overstated and expenses are understated. So that is the procedure. Hopefully you've picked something from that. Now let's move. Describe the substantive procedures the auditor should perform to obtain sufficient and appropriate audit evidence in relation to trade discounts receivable for P company. So these are substantive procedures. For substantive procedures, remember where you can, we say the following. You must make sure the following is there or the following is clear. Number one, what is the audit procedure? What should the auditor do? So we need to know what should the auditor do? What is the audit procedure? Besides the audit procedure, we also need to know where the procedure is to be carried out. Where do we carry out the procedure? And also, if we can explain why. What do you want to verify? By this procedure, what do you want to verify? The question was not specified. Is it? No, because others will specify the assertion. So why? What assertion do you want to prove? Or we can say, what do you want to prove? We don't just carry out a procedure. There is something that we want to prove. So if we want to verify the described substantive procedure the auditor should perform to obtain sufficient and appropriate evidence in relation to the trade discount receipt. Let's go and read if we have anywhere where there's the discount receipt. Just help me check. So the last thing was here. Then so here, P company values inventory in line with the industry practice, which is to use the selling price less the average profit margin. Okay, maybe before we even move on the audit risk, this one. We are allowed to use Manguma methods. We are not just forced to use law of cost and net realizable value. We use these other methods if they are close to the cost. So, kana mari inoburiswa tikashandisa the cost, law of cost and net realizable value. Yakada kufanana neiri kubuda using the method, it is allowable. Zvisingadiwe ndezvekuti tishandise another method, which gives us a very huge difference. So, on your risk, if they are using another basis, which is not law of cost and net realizable value, you would say on the risk that, you'd mention that they may have used the base which is not acceptable by IAS 2 or which does not, which is not acceptable, which may result in overvaluation of inventory. So on the responses, we need to recalculate the cost using the best that they used, and we calculate using the IAS 2. Then we compare. If there is no significant difference, then it means no, the basis that they used is all right. But if there is a significant difference, then it means the base that they used is inappropriate. P company values inventory in line with the industry practice, which is to use the selling price less the average profit margin, which the directors consider to be a close approximate to cost. Oh, so if it's approximate to cost, then we are allowed to use it. But still, as auditors, we are allowed as well to verify that is this really a close approximate to cost. The company receives a trade discount from its main supplier, which is linked to the total amount purchased during the year in accordance with the supplier contract. The company receives a trade discount. Company receives a trade discount from its main supplier. So we are receiving a discount from the suppliers. As on the receipt side, we are receiving a discount from the suppliers. Just a moment, I want to put my phone in the charger. Just okay, let's resume. So I was reading the case. The company receives a trade discount from its main supplier. Which is linked to the total amount purchased during the year. In accordance with the supplier's contract, the amount is reclaimed after the year end based on the actual volumes purchased over the year. P company is expecting to include a receivable in relation to this trade discount is expecting to include a receivable in relation to this trade discount of 980 at the year end, along with a corresponding entry in cost of sales, which relates to goods which have been purchased by the year end. Okay, so there is an issue with the trade discount. We try to digest the statement again. So I think the first thing we can talk about here, if there is a policy for a discount, we need to confirm that this one indeed exists. So I would want to start with that. Just the verification of what they agreed. So review the contract with the suppliers. Review the contract with the suppliers to confirm the terms and the conditions. To confirm the terms and conditions of the discount. Terms and conditions of the discount to ensure that The entity is entitled to any discount at the year end. What can happen here is going to have a case where they are lying. So in terms of the assertion here, the assertion we're looking at is more like ownership. Are they entitled to any discount? Did they enter into an agreement, or they're claiming a discount that they are not entitled to? Do they have any rights over the discount? So that's what we'll be testing. So the procedure is to review, and what are we reviewing is the contract with the suppliers. Then also, there is an issue of estimations that is being mentioned. In accordance with the suppliers, the amount reclaimed after the year is based on the actual volumes. So what can we say? We can say if there is an element of uncertainty involved, why not compare the amount of discounts? Let me read again for the last time. The company receives a trade discount from its main suppliers, which is linked to the total amount purchased during the year. In accordance with the supplier's contract, the amount is reclaimed after the year end, based on the actual volumes purchased over the year. Is expecting to include a receivable in relation to this. Okay, so at the end of the year, they are expecting to have a receivable of 980 to the discount. They're expecting to be given a discount of 980. So this could have been overstated. So we can use analytical procedures. We can compare the expected discount of 980, the expected discount of 980 to the previous year, and discuss with the management if there are any significant fluctuations or any significant differences. Let's understand from them, because there's an element of estimating them. We want to understand why you're estimating a discount of 980 when last year you did not even get that much. How much did you buy any goods? Are you expecting to? Are there any new inventories that you have bought that you think the discount may be to that much? We can also recalculate the discount, the projected discount. So you can say review from the contract. How the discount will be calculated, and recalculate the discount receivable. and recalculate the discount receivable to confirm its accuracy. We put it in different ways, but I think that can work. Then lastly, we need 4. The last one we can talk about for this discount we can talk about because if the discount is to be received, we can then check if we have not paid at the end of the year. So we can look at the bank. The bank can be used to agree if this was successful. So we can say, let me put it this way, review the post year-end bank statement and suppliers statements to confirm if any receipts were made and any adjustments were made relating to the discounts. Because from what I heard, they are recording it as a receivable, meaning that we are the discount after the year end. So we can just check, did we receive that? The question was a bit tricky, but that is what I would say. Now let's move on to the next question. So identify and explain 3 ethical threats which may affect C company's audit of P company. Yeah, sorry for a moment about the background noise. Okay, let's read through the ethical issue here. So the question is then saying, come up with the threats and the safeguards. Pick the threats and the safeguards. I think from the scripts that I marked, this one, justice was done to this one. So let's work together. So during a meeting, P company's finance director has mentioned to the audit engagement partner that he is keen to align the objectives of P company with its auditors. C company, with its auditors, C company. To assist in achieving this, he has suggested that the audit fee could be based on a certain percentage of P company's final profit for the year. P company's finance director has also requested that C company provide some accounting and bookkeeping services. The service proposed would be of a routine nature. One of P company's main suppliers, H company, is also audited by C company. Due to negative articles in the press, P company's finance director has some concern over the financial stability of H company. He has asked the audit engagement partner to inquire of H company's audit team as to whether there are any going concern issues would affect the supplier's ability to continue, okay? The audit manager is currently carrying out a review of staff for staffing for P company. She's considering including an audit assistant who is the daughter of the FD of P company. Okay, so that is the issue. So which can I ask you at least if you can get one, Barbara, if you can get one ethical threat, and it's safeguard. Wilma, you get one. I will also get mine. Then we move. So starting with you, Barbara, what is the ethical threat, any that you have identified?
Identified. Hello.
Yes.
I've identified an ethical threat, which is a self-interest threat, where the auditors are going to receive its fee based on final profit for the year.
Yes, there is a self-interest threat. So if you are putting that up, what happened on that one? Let's read it again. The finance director is the one that is proposing that. So you can say the finance director has suggested, the finance director for P company has suggested that the audit fee be based, the audit fee be based on the profit for the year. So if it's ethical threat, we need an indicator and an explanation of the threat. So this is an indicator. Then now let's explain the threat of our team. This is a contingent fee arrangement, and this is a contingent fee arrangement, and it creates a self-interest threat. This creates a self-interest threat. Why? As the auditor's decisions, could be affected by the desire to increase, we can say the auditor's judgment will be affected by the desire for more profit and reward. So they would want the company to have more profit so that they can get more rewards. So there is a self-interest threat. There is a self-interest threat. So yes, Barbara, you're not done. What then should be done?
Okay. The auditor should discuss with the management about their fee, which states that auditors should not accept contingent fees. Therefore, they should be paid according to their time they take to perform the work at the experience they have, and also their fee income should not exceed 15% of the total fees of the audit firm's income, total income.
Okay, the point here that you have mentioned, the first one is the key one. We can say they should C company should politely decline the offer, should politely decline the offer and explain that the audit fee should be based, explain that the audit fee should be based on the time, should be based on the time taken and the nature of the job. Not profit. So they should decline that offer. They should decline that offer. Okay, now let's move on to the next. This one, Yaya Wilma. Wilma, what's the second one?
All right. Sorry, I was having a network challenge earlier. But if the ethical threat, the other one that I might think of is maybe explain the the self-interest, since the audit manager is planning of including the daughter as the finance director.
Somewhere, somehow, can you read this? Are you seeing the statement? Yes, self-interest, but powers with finance. The daughter is the finance director. Then you rephrase your statement.
All right, the audit assistant. Sorry, sir.
Okay, let me help with that. Let me help with that one. So we are being told that the audit manager is considering including the daughter of the finance director in the audit team. That's the indicator. The audit manager. The audit manager is considering including the daughter. Including the daughter of P company's finance director. Let's indicate which finance director. The daughter of P companies, including the daughter of P companies finance director in the audit team. So this can cause two threats. It can cause self-interest and familiarity to the daughter. So the daughter will be affected by this is family, they are someone close to them. There is also self-interest, and even intimidation might also have a play there. So what then can we say? We can say the finance director is a close family member. Is a close family member. And this will possibly create familiarity threat or self-interest threat. Familiarity threat or self-interest threat. This will possibly cause familiarity threat and self-interest threat. In order to protect, or a self-interest threat, how? The daughter will be obliged to protect the actions of the FD. Okay, let's move on. The safeguard. So for this one, the best way is to just remove the daughter from the team. So the daughter must not be included in the audit team. The daughter must not be included in the audit team. As the threat is significant. The audit manager must look for an alternative member. Must look for an alternative member. So the third one, let me just maybe talk about it. I'm not going to write this one down. So for the third one, it's mine. Let's go back to the case. We have P Company's finance director has also requested that C Company provide some accounting and bookkeeping services. The services proposed would be of a routine nature. So there is a danger of self-review threat. So that poses self-review. So this can cause self-review threat, as we might end up reviewing some of the work that we prepared. So what then should be done? This depends on whether the company we are auditing is a listed company or is not a listed company. So did they mention anything? If the question is silent, you can assume the company is not listed. If it's silent, you can assume it's not listed. So if it's not listed, we can go ahead, but putting in place safeguards to just ensure that we don't audit the same work that we did. Or we can have separate teams. If it's an unlisted company, we can have separate teams to do the audit and to do the other services. But for a listed company, it's not allowed to provide both the audit and the non-audit services. Small one. A Harper company currently has a small internal audit function and is considering outsourcing the internal audit to a specialist company, T company. Using the table below, describe 2 advantages and 2 disadvantages to each company of outsourcing the internal audit function. Again, this one is not a case-specific question. It's a general question. So starting with Barbara again, what is the advantage of outsourcing the internal audit function? Outsourcing the internal audit function.
Hello.
Yes.
We can talk of flexibility, the availability of staff whenever the upper company needs an extra staff to perform the internal audit functions.
Yes, if we are hiring, if you're outsourcing, it means these ones are just specialists. They specialize with that, so they can be readily available when we need them. Unlike our employees might be occupied in some, they have work that they have to do as well. So you can get people that just specialize in that. So yes. Which other advantage? Wilma, outsourcing internal audits.
Maybe we can talk about the expertise or the specialized skills.
Yes, we can get people that are experts because they specialize with that. So we are likely to get experts in that particular field. We are likely to get experts because they specialize in that. So if we outsource the internal audit function, we can also get even advanced technology, because these they specialize with that. So they might even have, for example, if they are audit softwares, they might have the softwares available. It can also tend to save us in terms of the costs because we only hire them when we need them. We don't have to have an internal audit department within the organization. We only hire them when we need them. Now on the disadvantages, starting with Wilma.
It might be costly.
Come again?
Might be costly for the company.
Yes, it might be costly because these are specialists. They will charge you their expertise. It can be costly for the company, Barbara?
Since the company has already had some internal audit staff, they might lose this the already staff which the internal audit staff which were already in the company. If they fail to maintain, if they fail to give or to retain them in other functions in the organization.
That one, it's not well explained. Of course, the point is there, but the point that we're supposed to talk about is not losing the employees, because we are still getting the skills we need. But the point you're supposed to bring out is we might need to pay redundancy costs. So if we are making these employees now redundant, the cost of redundancy, it might result in making some employees redundant, which might increase the redundancy costs. And also, maybe still linked to your point, we could put it in, we could say, we are now too reliant on third parties. We lose the skills within, we fail to retain our skills, leading to over-reliance on third parties. So we are now relying on the third parties. We cannot self-sustain ourselves. We lose control over the internal audit function. We lose control over the internal audit function. Okay, so the next question was on controls. So we're required to test the controls. So for controls, for this one, because of our time, I'm just going to highlight what you are supposed to do. I think the likes of Anawuma, Msad Mandipa assignment, I would want you to finish this one. You're just going to now do this one only and send me your feedback. The second question, because the first one you're done with it. So a control deficiency, it's a weakness in the control system. A control deficiency is a weakness in the control system. What is limiting us from getting there? That is the control deficiency. So the control deficiency is a weakness in the system. So you have to highlight. So for the control deficiency, you have to highlight the indicator as well. We have to highlight the indicator. From the indicator, you need to tell us what is the weakness in the system. And what can be the effects? What is the weakness and its effects? In the financial statements. If it's something that's not being done, what is the possible impact in the financial statements? A recommendation, what should be done to correct the deficiency? What should be done to correct the deficiency? So for this one, if it's someone who must do it, or if it's a time frame, we need to know how frequent it must be done, how frequent, if it's a person who must do it. So in the test of control and the control recommendation, that must be clearly brought up. Okay, so your task for the week, this one is a must to do. You are supposed to do the full paper, the mock exam. So you do the mock exam, and I want my answers before Wednesday. So you're supposed to do the mock exam. So maybe next week we might delay, we might take longer so that we revise the mock exam. So attempt the mock exam, then you give me feedback by Wednesday so that I have time to review your scripts. So for today, I think we can end here.